Let me ask you something. If I told you that borrowing $10,000 could cost you over $1,000 in less than just 2 months, would you believe me? What if I told you the next loan cost you $12,000 to borrow $21,000 and keep that money just 70 days? This isn't a horror story. This is a real story of a pottery studio owner that we're working with right now. She needed money to open a physical location. And at the time, the Square loan looked like it was around 20% interest. It's high, yeah, but she had to do what she had to do to open. When you're that close to making your dream happen, you take what's available. And that's what she did. Here's the reality though. When your studio has a cash crunch, whether it's unexpected kiln repairs, slow season, or you need to make some payroll, fast money looks like the answer. And these Square loans and merchant cash advances, short-term financing products, they're all easy to get. No long applications, money hits your account really fast. The problem's solved, right? Well, not exactly, because these aren't traditional loans. They're fixed payback products. So that means that you agree to pay a set amount up front, and they take a percentage of your daily sales till it's paid off. The fee doesn't change based on how long it takes you to pay it back. And here's where studio owners get crushed. She took out $10,000 and agreed to pay back $11,385. Seemed manageable, but her studio did well. Sales were strong, and she paid it off in just 48 days. That $1,400 fee just turned into 236% annualized interest rate. She didn't plan for that. She just needed the cash to open her doors. But now she's paid off that loan and she still needs some operating capital. So she took another one, this time bigger, $33,000. She used part of it to pay off what was left on the first loan, and now she had about $21,000 in usable cash. Over the next 70 days, she paid back nearly $33,000. The cost? Almost $12,000. That effective rate of interest is over 1,550% when you annualize it. That's like loan shark. This is not an exaggeration. This is real math. And when fixed fee loans are refinanced or paid off quickly, you're squeezing that interest period into a short time. And the worst part, she didn't do anything wrong. She made a decision with the information she had. She needed cash, and this was available. But the structure of these products punishes fast repayment, and most studio owners don't realize that until they're stuck in the cycle. Remember we used to talk about Groupon and how it was like crack? Once you did it, you had to keep doing it? So what do you do about this? First, you need to see the real cost, not what the agreement says, but what actually happened in cash terms. Cash in versus cash paid out. Time outstanding, effective rate. Once you see that, you can make different decisions going forward. Second, you need to break the cycle. If you're currently in one of these loans, refinancing with another expensive product just restarts the problem. You need a plan to eliminate it without replacing it with something equally destructive. That might mean a traditional line of credit, an SBA loan, or restructuring how you manage seasonal cash flow so you're not dependent on these types of emergency capital loans. Next, fix your cash flow planning. Most pottery studios are seasonal, and you know when revenue dips. You know when the expenses spike. The goal is to build enough margin during the high season that you're not scrambling during the low season. That means better budgeting, better forecasting, and making sure you're not overextending during the busy months just because the cash is plentiful. If you do need financing, get real financing. A business line of credit from a bank or credit union will cost you probably 6 to 12% annually, not triple or quadruple digits. An SBA loan might take longer to get, but it's structured to really help you grow, not to trap you. Even a term loan from a local lender is better than a fixed fee merchant product that compounds costs when you pay it off early. And here's something else most studio owners don't know. There are alternatives that aren't banks. We work with lenders who specialize in business capital and expansion loans for small businesses just like yours. They understand studios, they understand seasonal cash flow, and they can offer financing options that don't trap you. If you need capital, there are better options out there. You just need to know where to look. Finally, work with somebody who understands the numbers, not someone who sells you the loan. Someone who shows you what it actually costs and helps you avoid it. Someone like me, I specialize in working with studios, and I can help you model out what these products really do for your cash flow and help you build a financing strategy that doesn't bleed you dry. Here's the bottom line. These loans are not built to help you build your business. They're designed to extract the maximum fees in the minimum amount of time. And when you refinance them and pay them off quickly, the cost is skyrocketing because the fee stays the same, but the time compresses. Now, you can't change what's already been paid, but you sure can make sure it never happens again. Get clear on the real cost. Build a plan to eliminate expensive debt and fix your cash flows so that you're not dependent on emergency financing. Work with somebody who keeps you out of these traps in the first place. If you feel some pressure from these types of loans, I'm happy to talk with you because your studio deserves better than a predatory financing disguised as a convenience. So stay proactive, stay informed, and make sure that every dollar you borrow is working for you, not against you.